I hope everyone has had a good start to the new year. Today, I'm here to talk about a slightly different topic than what we normally talk about. Normally, we're here to discuss different option strategies and how to deploy them using options play. But I wanted to touch up on a topic that we don't get to talk about a lot, but is actually quite critical to the success for any type of trading, whether you trade options, whether you trade equities, whether you trade futures or Forex, any market. The crux of a successful trader is really has a lot to do with how they manage risk and how they manage their money. So this is a topic that is, like I said, a little different. This webinar is going to be a little shorter than we normally do, but it is a very, very important topic. So I want to take a little bit of time out today and discuss, what are the best practices when it comes to managing risk and money for your trading accounts. And this is really a topic that I wanted to cover since December may have been a tough trading time for a lot of traders, including ourselves. There was certainly a string of losses in December for a lot of users that were long the markets. So how do you actually go about managing that? How do you actually prevent some of those types of months from blowing up your account? Those are some of the things that I'm going to want to. Those are some of the things that I want to cover here today. Before we go ahead and get started, for those of you that are brand new to options play, welcome. For those of you that don't have access to an options play account and want access to the things that we are offering here, please sign up for a 30-day free trial at optionsplay.com. For those of you that are already members of Options Play, welcome back. I want to make sure that, in the slides that we send out to everyone after we finish this webinar recording, there's some important links that I want to point people to. I might reference a few times during the webinar, the weekly options education webinars that we've recorded previously. If you want to take a look at those previously recorded webinars, make sure you click on that link in the slides. In the slides today, I also have some important links for some new tools to help you calculate the appropriate number of contracts to trade for your account size, as well as also what dollar amount to risk per trade. So really important for those of you that are following along in this webinar to make sure you download the slides afterwards. There are some important links, including the Options Industry Council, which we're not going to talk a lot about options today. Today is going to be more focused on just overall money management, regardless of what asset class that you trade. But for those of you that want to learn more about options, very important link to go to the Options Industry Council to go ahead and do that. Now, just to get started, my name is Tony Zhang. I'm the Chief Strategist here at Options Play. We're going to go over a few different things here today, and we're going to kind of work our way backwards. So first, I'll talk a little bit about what is the golden rule when it comes to risk management. I'm going to start with that just so everyone knows kind of what the end result is, and then what we're going to do is we're really going to work our way back to how we get to that golden rule, or how do we get to that number. So in order to walk you guys through how we get to that end number, I'm going to go through a series of charts to really help facilitate what I'm trying to teach you here today. So first, what I want to do before we jump into anything related to money management, I want to first just discuss the difference between a linear versus exponential function, because that's really the key to understanding all the things that we're going to be describing here today. There's a very powerful tool in exponential functions, so we want to talk about how it works in our favor and how it works against us, because that's really going to be the crux for understanding why the risk management techniques that we use is applicable. I'll talk a little bit, once we have a better understanding of what an exponential function is, then we're going to talk a little bit about the high watermark, why that's so important to understand, because that helps you define what should be your absolute drawdown that you can sustain in an account before it becomes almost unreasonable to recover from that drawdown. So those are some of the things we're going to discuss here today. And I think this is a topic that probably is applicable to any of you that have ever traded before, no matter how big or how small the account is. Blowing up your account is certainly one thing that we all want to avoid. However, I would imagine that some of you on this webinar may have in the past blown up your accounts on some trades. So I really want to talk about blowing up your account. What does it mean to blow up your account, and how do you actually go about potentially avoiding it? And in order to do this, so we really have to be realistic in analyzing, how many consecutive losses can we take in an account before we really blow it up or do some significant damage to our account where it's difficult to repair from. So I want to talk a little bit about statistics and what you should plan for in terms of consecutive losses. And then from all of that we're going to learn, what we're really going to do is we're going to work backwards. It's going to be a really simple math equation for us to really get to the bottom of how do we actually calculate the amount of risk and the amount of money that we should be putting on the table for each individual trade. So let's go ahead and get started. I'm going to start off with the golden rule of risk management, just so we can understand what we're working towards at the very end. And it's really simple. The golden rule of risk management for most professional traders is to never risk more than 1 to 2% of your entire portfolio per trade. Now, when I talk about your portfolio, I don't necessarily mean your entire investable assets. I mean the portfolio that you have for speculative trading. Now, this doesn't include your 401k. This doesn't include the assets that you might hold that are illiquid or cash that you're holding. This refers to the amount of money you have in your brokerage account that you're willing to put towards speculative reasons. And for any one trade that you apply in this particular account, you should risk no more than 1 to 2% of your portfolio per trade. And everything we're going to go through today is helping us work backwards as to how we get to that number. Now, the one thing to really think about when you consider risk management or money management is that a lot of times when we look at an investment, when we look at trade ideas, when we look at trade performance, we're always concerned about returns. Everyone asks, well, what type of returns can I expect? However, returns or gains is something that's out of your control. But what is in your control is losses. You can control how much losses you have in a trade. And that's a really important thing to remember. And I think this will become a little bit more apparent as we get into the next slide as to why managing your losses is so important. And what we really want to do at the end of all of this, the goal of risk management and money management is to make sure that you have enough dry powder in your account to live another day. If you ever get to that point where you don't really have enough dry powder to live another day, then you've been unsuccessful in terms of managing your risk and managing your money. So that's the goal here at the very end. I wanted to start off this webinar by talking about what is the end result, what is the goal here, and then we'll work our way backwards to understand why we get to that. So in order to do that, I want to first talk a little bit about the difference between linear versus exponential functions, because when we talk about portfolio gains and losses, they have a compounding effect, and that's very, very powerful. Any of you that have learned about how interest rates compound, and as long as you start as early as possible and let it compound for as long as possible, the growth is exponential, and it's a very powerful tool. However, this works both ways. Meaning if you have gains, they will exponentially compound in your favor. However, when you have losses, they will also exponentially compound against you. And the only difference between gains and losses is that there's no limit as to how far your gains can be, but there certainly is a limit to how much money you can lose before you run out of money, which is why it's really important to understand the power of exponential functions, but by understanding it, you also understand that if you have losses that start adding up, they will just immediately eat away at your account faster and faster to the point where there really is no way to recover. And that's really the most important thing to understand in order to understand the rest of the slides. So keep in mind that both portfolio gains and losses results in exponential growth. The only difference, again, is that gains, there's no upside limit as to how much gains that you can get. However, there's absolutely a downside risk. There's a downside cap as to how much money you can lose. So the goal of everything that we're going to discuss here today is about minimizing risk, because that's critical to prevent total portfolio loss. And that's what we're all here to prevent, is that total portfolio loss. That means that you no longer have enough dry powder to continue trading. So what I'm going to do now is I'm going to go through a series of charts, and they're effectively going to show you exponential functions and show you why it's so essential in working our way backwards to that golden rule. So what I'm going to start off with is talking about the gains required to break even. This is what we consider the high watermark. And this chart here that I have here on the right describes how much return you need to have to break even after suffering a certain amount of loss. So as you can see here, after suffering a 10% loss in my portfolio, I need an 11% gain to get back to my break-even point. At 20% loss, I need a 25% gain to get to break even. And as you have larger and larger losses, as you get closer to 100%, the gains that you need effectively approach infinity. So if you lose 50% of your portfolio, you need 100% gain just to get back to break even. So basically, what I'm trying to point out here is that gains required to break even grow at an exponential pace. So it's really important to try to limit the amount of total loss you have in your portfolio so that you never have to have this really extreme move just to get back to break even. So the goal here is to minimize your portfolio drawdown. And the rule of thumb here, generally speaking, is that whenever you have portfolio losses greater than 25% of your entire portfolio, it becomes very difficult to recover from. And the reason for this is really because if you lose 30, 40%, you need to almost double the amount of winning trades just to get back to break even. Now, I don't know about you, but doubling the amount of winning trades that you have today is an almost impossible feat, especially if, let's say, you're right on your trades 50% of the time. Now you have to be right 100% of the time on the next number of trades just to break even, which is virtually impossible, which is why if you look at any hedge funds, if you look at any asset managers, anyone that's ever suffered more than a 25% drawdown in their account is almost never gets back to break even. They never get back to their high watermark. So that's why it's extremely important for us to learn in the next few slides, how can we keep our portfolio losses to try to minimize that to as small as possible, but no matter what, try to keep it to under 25% total loss occurred so that we at least have some fighting chance of getting back to break even. Anything beyond that, it's going to be difficult. So let's talk about blowing up your account, because this is something that perhaps especially some of you that may have started with a small account, may have done and may have blown up your account before. I'm sure some of you may have done it in 2008. Some of you may have blown up your accounts in December. Some of you may never have blown up your account. Hopefully, we help prevent you from doing that. So the chart I have here is, again, another exponential chart, but is really critical to trading. What I have here at the bottom is the percentage of your account that you're risking per trade and the number of trades that it requires to effectively draw down your whole account or blow up your account. So if you're risking 10% of your account per trade, all it takes is 10 trades in a row for you to lose every single dollar that you have in your account. If you are risking 5% of your account, then you have 20 trades in a row in order to blow up your account. But as you can see, between 5 and 4, it goes from 20 to 25 to 33 to 50 to 100. And it grows at an exponential function for every 1% that you decrease your trade by. So every percent less that you risk results in a large growth in the number of trades it takes to blow up in your account. And the goal is simply just to maximize the number of trades that it takes to blow up your account by minimizing the risk that you take per trade. As you can see, if I'm risking anything more than 5% of my account per trade, this will result in 25% per portfolio losses quite often. So we said that we want to make sure that we don't exceed 25% losses in our total portfolio at any one time. So if we're risking 5% of our portfolio per trade, you're going to see 25% losses in your portfolio somewhat often. It might happen a few times a year. So keep that in mind when you think about how much of your portfolio you're risking per trade and what does that impact to your bottom line at the end of the day. So in order to then understand how much of your portfolio you're risking, that really depends on, well, how often can I expect to have consecutive losses? So what I have here is a chart of the probability of having consecutive losses based on the type of trading you do. Now, this is referring to option trades, but you can also look at your win-loss rate for any other asset class, whether you trade stocks, futures, forex. You can look at what percentage of trades do you win. What I have here on the left-hand side is the probability of profit. So for those of you that trade debit spreads, long calls and puts, you'll be more on this lower end, 30 to 40%. For those of you that trade things like short calls, short puts, credit spreads, iron condors, you might be on the higher end of the spectrum. And what this tells you is the probability of having a consecutive number of losses based on the type of trades that you do. So what I have here is I think most people will find that their win rate is somewhere between 40 to 60%. I think 30 to 70 is kind of on the extreme side. But if you see anywhere from 40 to 50% or 40 to 60% win rate, for you to have 5 consecutive losses at a 50% win rate, it's about a 3% chance of that happening. So fairly low probability. You know, as you get to 7, you start going under 1%. So everything that's highlighted in red is anything under a 1% chance of having a this number of consecutive losses. So if you have a 50% win rate, to have 7 consecutive losses in a row is only going to happen roughly less than 1% of the time. So whenever we think about we're risking 1% of our trade, our account per trade, how many consecutive losses can we plan for or should we plan for in a worst case scenario? So the rule of thumb based on this chart is that you should probably plan for the possibility of at least having 5 to 6 consecutive losses in a row. And that's the reality of trading. And any of you that have traded hundreds of trades will know that it's quite possible to lose 5, 6, 7 trades in a row. That's not impossible. So what you really have to do is some basic arithmetic to understand how you can keep yourself from losing no more than 25% of your account per trade. And it's a simple math formula. The percentage that you're willing to risk per trade times the consecutive losses that you might want to plan for. So for example, if you're risking 2% of your account per trade and you have 5 consecutive losses in a row, that will equate to a 10% portfolio loss, which is well within the range of what we're saying is below 25%. So that's why we generally want to look at this 1 to 2% range, because you want to plan for at least, in my opinion, 5 to 6 consecutive losses. In a bad month like we had in December, you may have seen 8 or 9 consecutive losses. So even at that extreme, you're still within that 25% range that you're looking for. So what you're really planning for in this particular case with all risk and money management is simply thinking about what is my worst case scenario and can I survive that worst case scenario? Understanding that in that worst case scenario, if you are losing 40, 50% of your account, how difficult it is to recover and trying to avoid that. So it's all working backwards from avoiding a large loss that becomes almost unsustainable or incapable of recovering from that. However, I want to point out is that when you think about 5 or 6 consecutive losses, the way that I have presented to this chart, in my opinion, is actually slightly misleading. And the reason I say this is because when we talk about 1, 2, 3, 4, 5 consecutive losses, that's really referring to 5 fairly completely separate trades. However, what we tend to find with a lot of option traders is that your trades are actually quite similar. What I mean by that is that a lot of option trades tend to be what I consider concentrated positions. What do I mean by that? If you have 2 stocks that you have long positions on that are expiring on the same expiration date, I consider that a bit of a concentrated position, because all it takes is for that market to move against you that 1 week for both trades to be consecutive losses. So when we think about your positions, you don't want to just think about individual trades that you have. You want to think about positions grouped together based on concentration risk. So an example of this is that you want to distribute your trades across expirations, long, short, and potentially even sectors. Because if you have 5 long trades in the same sector, all expiring on the same day, that's really more like 1 trade as opposed to 5 trades, because it could be easily, all you need is 1 adverse move in that 1 sector that 1 week, and now you have 5 consecutive losses at one time. And I wouldn't assign that a 3% risk, I'd assign that pretty much a 50% risk. So when we think about consecutive losses, we don't want to just think about individual positions, we want to think about grouping positions together and then putting them separately. So in order to really truly have this 3% chance of having 5 consecutive losing trades, that has to be five distinct groups of trade. So what do I mean by that? So if you're risking 2% of your account per trade, but you have 2 trades going on expiring at the same time, then you need to multiply that by the 5 consecutive losses that you might have. So you would have potentially a 20% portfolio loss. So keep that in mind. That you don't want to just think about the number of trades, you also want to think about how many groups of trades that you have. So this is really where, as you can see, if you are risking 10% of your account per trade, which I actually see more often than I care to say, and I see a lot of traders risking many times more than 10% of their account on a trade. If you're risking 10% of your account per trade and you're trading 2 trades per expiration, and you have a worst case scenario of maybe having 5 consecutive losses, that equates to 100% portfolio loss. That is where you no longer have any dry powder left to make any trades after that. So keep that in mind. This is why we always recommend that you don't really exceed more than 5% of your account per trade, because if you do, you're really putting yourself in a position where you are risking potentially 100% of your account at some point. Not at any one point, but having 5 consecutive losses will lead you to losing your entire account, and that's never a position that you want to be in. The next thing that I want to point out that does change these metrics again is that this is assuming that you're risking 100% of the trade per trade. Now, a lot of times, I do hear, and something that we do practice ourselves, and you should be practicing as well, is considering cutting your losses on a trade before you've lost 100% of its value. So if you're a stock trader, if you're a futures trader, this is probably fairly standard practice. If you're an options trader, sure, if you're long options, you have an embedded risk tolerance in there or embedded max loss. But even with that, a lot of times you would want to put on a stop loss order. So if you lose 50% of your account per trade, you are not risking that full 1 or 2%. You're risking half of that. So that is something to also consider as well. So the stop loss can reduce the amount of dollar amount that you're risking per trade. So for example, if you have a stop loss of 50% on all trades, it does reduce your risk by half. That is an easy way, or one of the better ways to vastly reduce your risk. So for example, when we talk about having 2 trades, 2% trade, with 5 trades, that's actually a 10% portfolio loss. Sorry, there's a typo here for 15%. That's actually a 10% portfolio loss. But if, let's say, you did those same trades with a 50% stop loss, you would actually have half the portfolio loss. So here, only 5% instead of 7.5%. I'll fix that in the slides before I send that out to everyone. So those are the 2 factors you want to consider when you're thinking about planning for worst case scenario is, are my trades concentrated? If they are, you need to make sure that they get grouped together. And if you are including stop losses in your trades, then you actually are reducing your risk even further. So those are 2 factors that you need to adjust for when you're thinking about this type of calculation. So with all of that understanding of trying to minimize portfolio loss so that your high watermark is at least reachable, and understanding that the number of trades or the percentage of the account that you risk per trade heavily influences the number of trades that you have in order to break even. And this concept of planning for worst case scenario based on how many consecutive losses you can take in your portfolio, what that really adds up to is really why we get back to our number of why you should risk 1 to 2% of your account. And what I've created is just a nice chart for those of you that have different account values and really getting a sense for how much money can you actually risk per trade. And it's a pretty simple chart. If you have a $5,000 account, risking 2% means that you can risk $100 a trade. For those of you that trade options very often, you'll know that $100 a trade is not much. That's pretty much 1 contracts for most trades, 0 contracts for many other trades. So if you come across a trade where where the minimum risk per contract is $300 a trade, there's really not much that you can do. And I certainly don't recommend you to trade 6% of your account per trade. Even though you can, I don't recommend it. So as you can see, I would say the average option trade probably is in the $200 to $300 per contract range. So with that, you can see that you roughly need about $10,000 to $20,000 in your account to be able to trade one contract for most option trades. So that's really how we can work backwards, and that's why we always tell users when you're trading options, you want to roughly have minimum of about $20,000 to $25,000 in your account, because that allows you to comfortably trade at least one or two contracts at a time, but still stay within the parameters of risking no more than 1% to 2% of your account. The larger the account size you go, the more you could shift closer to 1%, which is probably the realistic number that you should be shooting for, is that 1% risk, because then you can have 10, 20 consecutive losses and still stay within that 5%, that 25% portfolio loss and still live to trade another day. So this chart's pretty simple to understand. I actually have this chart in the spreadsheet that I'll be sending out to everyone after this webinar so that you can look at this chart yourself, as well as a calculator for you so that you can plug in your exact account value, the exact amount you're willing to risk, and see what the dollar amount you can risk, and also calculate the number of contracts. So you don't have to memorize all of this. We've created a calculator for you so that you can take a look at this based on your own numbers. So the example here is that if you have a $50,000 portfolio and you're willing to risk 2% per trade, that means you can risk $1,000 per trade. So if you're trading something that has a max risk of $200 per contract, that means you can trade 5 contracts of that trade. And that's how you go about calculating the number of contracts that you apply to each individual account. It's a very simple math equation, not difficult at all. I would say the most difficult part for most people is sticking to this and not the actual calculation part. A lot of times when it comes to trading, our emotions comes into play. Sometimes we're very convicted on something, so we end up going big on a trade. I've certainly done it myself. I think anyone that's traded real money has probably been guilty of that. But this is really why we want to bring calculators into your life, is to try to take some of that emotion out of play and simply just provide calculators so that you know exactly how many contracts to trade, and you're not guessing or doing back of the envelope calculations. You have exact calculators to tell you how much to risk. So just a quick summary, you want to make sure that you increase and decrease your trade risk based on the portfolio value changes. What that means is that a lot of times what I tend to see from traders is that if they have 5, 6, 10 winning trades in a row, they start building a confidence that, hey, my strategy is really good. Let me start risking more money. That's not the right way to determine when it's time to risk more money. It's only that when your portfolio has grown enough that justifies increasing your risk. No matter how profitable your strategy might be, you want to make sure that you think about the profitability of your strategy in a long run. That means over hundreds of trades, not over a sample of 10 or 20 trades. It's just simply not larger enough sample size to say, is this trend going to continue? If that trend continues over hundreds of trades, then you may want to evaluate, how much you're risking per trade. But for the most part, you only want to increase the number of contracts and the dollar amount you're risking based on the growth of your portfolio. And you never want to trade more than the contract calculator tells you. So what we've done is we've created a calculator for you. We're giving everyone free access. You can access it at this particular link. And what I'm going to do is I'm going to show you this calculator real quick just so you can see it. It's really, really simple. What it does, it allows you to enter your account value. So whatever account value you have, let's say you have a $35,000 account, you can enter the percentage of risk that you want to take per trade. Like I said, we always want to tell you to risk somewhere in that 1% to 2% range. However, at the end of the day, that's a number that's up to you depending on how comfortable you are with your strategy. And what it does is it spits out the dollar amount you're willing to trade. And what you should do with that is every single time you come across a trade, when you're in options play, you can use our max risk number to understand what is the risk that you have on a particular trade. So let's say in this particular AIG call, I'm risking $256 per contract. So I can enter that 256 here. And what it does is it tells me exactly the number of contracts to trade. And it does it by rounding down. So you're never risking more than what you should. It never exceeds that that percentage amount. And what that does is it gives you a much better understanding as to how much you're actually risking, and kind of takes the emotion out of calculating how much risk or how many contracts you should trade. It does all of that work for you. You just update your account value as it grows. So maybe once a month, as your account value fluctuates, you enter the dollar amount, and then on every single trade, you enter the actual trade amount you're risking, and it will spit out the number of contracts to trade to try to make your life a little easier. We've made the spreadsheet public so everyone can view it. And then what we'll really do is make sure that everyone, and on the spreadsheet, I also included those two charts that I have in the slide. So if you want to review these charts, you can do so and see for yourself. So with that, just a review of what we're talking about here today, the golden rule for managing your risk with all the things that we went over here today. The end result is to try to risk 1 to 2% of your account value per trade. Again, if you exceed that, you certainly can, but you start running the risk of potentially risking way more than 25% of your account. And that in itself is not the end of the world, but if you do risk more than 25% of your account, or if you do have drawdowns of greater than 25% of your account, it is very, very difficult to come back from, and that's not a position you want to put yourself into. And the reason for this is really because returns and losses compound exponentially. So you want to make sure that you manage your downside returns or downside losses. And the best way to do that is by minimizing the risk per trade. That minimizes your portfolio drawdown, which is really the crux of all of this, because that's the one thing that's impossible to come back with, is a large portfolio drawdown. In order to do so, you will always want to plan for a worst case scenario of having potentially at least 5 to 6 consecutive losses. It's very unreasonable to say that I won't have 5 to 6 consecutive losses in a row in my account. And what you want to do is, even in that worst case scenario, you're not risking more than 25% of your account. And that's going to allow you to continuously improve upon your strategy and continuously to effectively live another day to trade, because that is effectively the whole point of trading. And one of the best ways to do that, and to prevent having more than 5 to 6 consecutive losses in a row, is to distribute your trades across expirations, across sectors, and between long and short. Because if you have all your trades expiring on the same expiration, and they're all long, and they're all concentrated on the same sector, that's like having one consecutive trade. That's not having 5, 6, 10 trades. That's really only 1 or 2 trades if you're very concentrated. So keep those things in mind. So with that, I just want to thank everyone for taking the time out this afternoon to listen to us and talk a little bit about a topic that's very different from what we normally talk about. However, I think is a very, very important topic for everyone to understand. So with that, I want to thank everyone for taking the time out this afternoon. This webinar is recorded, so I will send out the slides to everyone with the recording. And at this time, what I'll do is I'll answer any questions if you have any questions regarding anything I just talked about here today. So please type them into either the chat window or the Q&A window, and I will answer as many questions as I have time for. Laura, thank you so much. I'm really glad that you guys find this helpful. Jose's asking, in the example of risking 2% on 5 consecutive losses, 10% is not correct. It's actually 9.6. You're absolutely correct, Jose. So that's presuming that you are readjusting your trades every single time. So if you readjust this account value after every single loss, you are right. You're not actually losing 10%. You're actually losing 9.6%. You're absolutely correct. But we are assuming that in the short run that you're not readjusting your position sizing on every single loss or every single gain on your account. Spencer, thank you so much. I really appreciate that. And Jose, you're absolutely right. So Jose is correct, meaning if you have 10 consecutive losses of 10% rule, that's not 100% loss. But my point is that you're not necessarily making 10 consecutive trades one after each loss, right? You are likely having 4 or 5 trades on at the same time, and those are all initiated from the same account value. And that's really why when we talk about consecutive losses, I want to point out that this sometimes can be quite misleading because this is not actually 10 consecutive losses unless you're the type of trader that only places one trade at a time, waits till it expires, recalculates your account value, then readjust your positions. But that's not quite realistic, Jose. We tend to find that most people will, if you have a $100,000 portfolio, you might put on 5 trades at a time for $1,000 each. So you are risking 5% of your portfolio at a time. What kind of trades correspond to different pops? So the pops don't necessarily represent different trades. They simply represent your win rate. So for example, the 30% pop is closer to what's more likely someone who's going long calls and puts, buying perhaps debit spreads, 30 to 40% range is typical. Credit spreads is more a little bit higher, 60 to 70% is typical. So those are the types of ranges that we typically see with options trades. Raymond, you're very welcome. I really hope that, this is, again, very different from what we normally cover, but also very, very important. And reviewing the power of exponentials is extremely important, understanding why risk management is so important because of this chart. It works both ways. When it works in your favor, it looks really good, that hockey stick. But when it works against you, it's really ugly. So that power of exponentials is extremely important to understand. Greg, please post the web address for the spreadsheet. Okay, 1 second. Let me get that link. You can access the spreadsheet there. I don't know if this is shareable here. Let's see. Let's make this public. Okay, so that second link should be able to allow you to access it. I should probably lock down this. Okay, so I just shared the spreadsheet, and I hope that I didn't just allow everyone to modify the spreadsheet. Let's see. Yeah, everyone can view. Good. Okay, that works. Jason, thank you so much. I really appreciate it. Michael's asking, does the account value include the total value of the account or the amount of cash available for trades? So I would say that your account value is the total account value, which includes the cash that you have available for trades. So this is really the account that you have for speculative trading. That means that it's not your 401k, it's not your retirement account. Some of you may be trading in your retirement account, but you just take the percentage of that account that you're willing to put at risk for speculative trading, and that's the amount that you should enter into this spreadsheet. Any other questions? Okay, maybe the Google Doc may not work. I may have to send everyone an actual Excel spreadsheet that you guys can edit. So I will work on that and make sure that that's out with the recording that goes out. Because if everyone has access to edit, then you're all going to be overwriting each other, unfortunately. So I will likely have to send you a link that allows you to download an Excel spreadsheet. So sorry about that. Greg, the link that I sent before is just going to take you to the same link and you're going to have the same problem. So I will redo that link and make sure it goes to so that you guys can actually download an Excel spreadsheet that will allow you to do this. Larry, I'm really happy that I've brought a different approach to your thinking in terms of risk management, and that's really the key of, the showing you the difference between the linear versus exponential functions, because I do think that is an important concept to understand in understanding how money should be managed in your account. Any other questions? Jose is saying that you may be able to download a copy. So you should be able to maybe download an Excel spreadsheet in order to just have a copy for yourself that you can edit. But even if that's the case, I will include a link for everyone that automatically downloads a spreadsheet for you in the recording that I send out. So thank you, Jose, for that suggestion. So again, for those of you that are on this webinar and you want access to it, you can click on File, Download as an Excel spreadsheet. That will allow you to download the spreadsheet and play around with it, but I will send out a link with the actual spreadsheet itself as well. Robert, you're very welcome. Any other questions? If there's no other questions, I just want to thank everyone for taking the time out this afternoon. I'm actually going to talk next week, again, not on a topic specific to options trading, but talking about more about the statistics of bullish and bearish markets and how to actually position yourself for each one. What are the option strategies that make sense for bullish and bearish markets, because they are quite different and you can't just think of one as the inverse of the other. And once I kind of put some of the numbers behind it, it'll be a little bit more apparent as to how to position yourself differently between bullish and bearish markets. So that's what we're going to talk about here next week, and I hope to see you guys there. So have a good afternoon, everyone, and I will send out the webinar in about 30 to 45 minutes, and I hope everyone has a great afternoon.